In America, spring often brings what feels like a seasonal bonus. A notification pops up, a direct deposit clears, and a sudden influx of cash arrives from the federal government. But a tax refund is not a government bonus. It is simply the return of excess money that was pulled from your own paychecks throughout the year. When you receive a refund, you are getting back an interest-free loan you made to the federal government. To see how this process works, we need to look at the mechanics behind the U.S. tax system. Note that this is educational content, not personal financial, tax, legal, payroll, or investment advice. Treating a refund as a windfall obscures the actual financial mechanism at play. To understand the numbers that show up in your bank account, we have to follow the chronological path your income takes from the moment you earn it. That path determines exactly why some people receive a large check in April, while others end up owing money. This map has 4 stops: gross pay, federal withholding, your year-end tax return, and the final outcome, a refund or amount due. Tracing this route provides total clarity over your monthly cash flow and year-end results. Under United States federal law, income taxes must be paid as the income is actively earned. This operates as a strict pay-as-you-go system. The cycle starts with your gross pay. This is the total amount you earn from your employer before any deductions occur. The money that actually hits your bank account is your net pay. The difference between the two is created by mandatory deductions, primarily the federal income tax withholding line on your pay stub. This direct withholding mechanism has been a standard part of the American payroll system for decades. Employers act on behalf of the IRS, separating the tax from your wages and sending it to the government before you see it. Your net pay, therefore, relies entirely on the specific withholding instructions your employer receives when you start your job. Those instructions are delivered through Form W-4. This document tells your employer's payroll system exactly how much money to withhold for federal taxes. In 2020, the IRS redesigned the form. The older system, which relied on calculating withholding allowances, was completely eliminated to align with newer tax laws. The updated W-4 uses a simplified approach, calculating your withholding based on filing status, dependents, and multiple jobs. Updating these details immediately adjusts the mathematical output, changing how much money is pulled from your next paycheck. Form W-4 is the master control dial for your payroll. It dictates the precise size of every paycheck you receive. That continuous paycheck withholding builds up over the year. Then comes the spring tax season, when your total annual earnings and your actual federal tax liability are officially calculated. Tax deductions, like the standard deduction, operate by shrinking the total amount of your gross income subject to taxation. Tax credits operate differently, offering a direct dollar-for-dollar reduction of the final calculated tax bill itself. The IRS processes all of these variables, your income, deductions, and credits, to arrive at your true final tax liability for the calendar year. These calculations establish exactly what you owe, setting up the final mathematical reconciliation against the money that was already withheld from your paychecks. This brings us to the end of the paycheck map. The final step is a direct comparison between the total federal withholding taken throughout the year and your final tax liability. If the total amount withheld from your paychecks exceeds your actual tax liability, the government returns the excess. Conversely, if your paycheck withholding was too low, a deficit gap appears. You are then required to pay the amount due. State income taxes and state refunds operate on a completely separate track, varying widely depending on your geographic location. Neither a federal refund nor an amount due is inherently good or bad. They are purely the mathematical results of the withholding settings you chose earlier in the year. A large lump sum refund has practical utility. For many U.S. women, it serves as a way to fund emergency savings or pay down debt. But adjusting your withholding to receive a larger monthly paycheck might provide more reliable daily cash flow than waiting 12 months for the government to return your money. The IRS provides an online tool called the Tax Withholding Estimator to help you calibrate these numbers. Running your numbers through this tool allows you to actively design your W-4 inputs. You can target a specific outcome, whether that is a seasonal refund or a precise zero-balance return. True financial empowerment comes from piercing the illusion of the bonus. By understanding the paycheck map, you take deliberate control of the withholding dial.